Bill Simon joins us now, former president and CEO of Walmart U.S. Bill, very good morning to you. Thanks for joining us. I guess headline, first of all, on the quarter. What's your takeaway? Q4, there was expecting some softness following Target, but clearly the share's still declining a little further than where they already had priced in.
Yeah, I wouldn't be too concerned with the quarter itself. I think there's some interesting things in the annual, the full year report that I'd be keeping an eye on. But a lot of retailers reported a strong Black Friday, Cyber Monday, and then a strong final week. But this holiday season, we had the shortest period between Thanksgiving and Christmas. And so a lot of retailers reported some softness in there, and that's really what Walmart's saying happened for the quarter. For the year, the operating income still is challenged. And there's some information in there that, when you peel apart, concerns me about where the sales are coming from.
Talk us through that, because I know you've been focused on that for a while in terms of the factor that maybe you've got some great online sales, but it's pressuring margins.
Yeah, that's right. If you look at the segment results in their press release this morning, you can see that the U.S. sales, as you reported, the comp sales were up 1.9, but the e-commerce sales contribution to that was over 200 basis points. So net effect was the brick and mortar stores standalone declined in same-store sales. And so the report of increasing grocery online sales, which is what's happening, and Walmart needs to do that because that's their moat for Amazon's online business. That's coming at a really severe cost to operating income. And if you look at their op income line for the company reported for the year, it was just over $20 billion. At its peak, that was $29 billion about 5 years ago. And when they did their reset in 2015, that dropped down to around $20 billion, and it's been hovering there for a while. So all this new business that they've been generating, $40 billion or $50 billion, has come at an impact of a loss of $9 billion a year in operating income. So it's very, very expensive.
Well, it might be expensive, but it's not really coming at a severe cost relative to the share price, though, overall over the last couple of years. So presumably you accept it's the right strategy, even if it doesn't always mean every single financial metric celebrates that factor?
No, exactly right. Shareholders are dictating that that's the path that they take. The question is, for me, at some stage, when do you start seeing operating income growth? And how do you figure out, how does the current strategy transition into, an increase in improving operating income? The other piece for me that I'd be looking at, and it's in their release, is they indicated all the changes that they've undergone, and a new CEO in the U.S. segment, a new chief merchant in the U.S. segment, a new chief operator in the U.S. segment, a new CEO at Sam's Club. There's a lot going on there, particularly in the U.S. segment, which is the engine to this whole venture. It funds all their ability to do all these other investments in international and in e-commerce. And John Furner, the new CEO, is a talented executive, but anytime there's a transition, you got to sort of keep an eye on things.
Bill, given what we heard from Apple yesterday, how do you think that is related to Walmart, first for the next quarters, but also longer term in terms of where it supplies various things from?
I think that Walmart's dependence on China is overestimated by many. The grocery business is enormous. So a few years ago, they reported that about 2/3 of what they sold was either made or grown in the U.S. China represents about 20% had represented about 20% of the balance of that. And with all the trade tariff, discussions going on over the last 2 years, many companies, including Walmart, had either moved or made plans for alternate supply lines. And so I think, and I heard you guys talking about it in the prior segment, nobody really knows where this virus is going. But in the current context, I think it would be too early to assume that it would be anything of significant impact to Walmart's business.
We do think Walmart in China. I don't know, Bill. That's probably kind of an anachronistic view somewhat. But how much actually of Walmart's products are touched in some way, shape, or form by what happens in China? What percentage would you say?
Well, there are large portions of particular product lines. So a lot of the apparel is. But apparel isn't a significant piece of, it's a big piece of the business. Don't get the wrong idea. And it's a big margin driver. But it isn't It isn't a huge volume play. And like I said, over the last 2 years, Walmart and virtually everybody else has found alternate supply lines to deal with what they thought would be, really harmful tariffs. And so there are other alternatives. I think a lot of the toys that had historically come out of China and plastics, but toys have been a relatively flat to declining segment anyway. So I think the exposure to China for Walmart has been overblown.
That's Karen. Let me ask you a question about the margin. So the margin's obviously been depressed as they spend and get online sales. Where do you think is sort of a goal margin that they can reach?
What I'd be looking for is margin stability. What they're doing, and it's a good strategy, is transitioning their food business to a digital business. The order online and pick up in store or grocery delivery is a really strong strategic advantage that they have in the e-commerce battle with with Amazon. But that comes at a cost, because you have to pay somebody to put it on the shelf, and then you have to pay somebody else to walk around the store and take it off the shelf. So by definition, that's a lower margin than the brick and mortar grocery sale. And I'd sort of be looking at where that stabilizes, and it's probably going to cost 400 basis points to their food margin if in that particular portion of sales. So as you evaluate which or how much of that goes buy online and pick up in store or delivery, and then you evaluate how they're able to offset some of the margin through operating efficiencies, and they're brilliant at developing operating efficiencies. I'd be looking at a margin somewhere between what their typical grocery margin is in the mid to high 20s, to something that would be slightly lower than that.